Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone. Welcome to another episode of What is Driving Markets. Now, one of the key questions which investors have, should we dial down risk amid the tariff uncertainty? Hi, my name is Vinay Joseph and I'm the host of this podcast. Now, Indian assets have started H2 2025 on a weak note. The surprise announcement by President Trump of reciprocal tariffs of 25% from August 7th and a further increase to 50% from August 27th has definitely soured risk sentiment and raised downside risk towards both domestic growth and earnings. Now, consensus estimates suggest the negative impact on growth to be around 50 bips through lower investments and exports, with potential indirect impact set to rise longer if this impasse continues. Now, given this, the key question is obviously, should we dial down risk in the near term? In our view, we still remain buyers and overweight on equities. Though near-term volatility is likely to stay high, the reason we are still positive is on 5 factors. First, improving macro fundamentals. High-frequency macro indicators such as PMI, IIP, auto sales are all pointing that growth is not only staying resilient but also improving. 2. Accommodative domestic policy. Policy momentum, both fiscal through the income tax cuts in the union budget and monetary via 100 bips of front-loaded policy rate cuts in 2025, along with a series of liquidity boosting measures, is likely to support a revival in domestic demand, offsetting partially the negative impact of tariffs. Third, earnings growth is improving at the margin. Now, the ongoing Q1 earnings of this fiscal year 2026 has been broadly in line with estimates, pointing to a gradual recovery. With the intensity of EPS downgrades which we saw in the previous few quarters much lower. Consensus expects Nifty Index EPS CAGR for fiscal year 2025 to 27 over the next 2 years to be a robust 13%, compared to the anemic 1% growth registered in fiscal year 2025. Fourth, relative valuations are still supportive of equities. Though the Nifty 12-month forward PE is closer to 20.8x, it is stretched versus its 10-year average of 18.2x. When we look at relative to bonds, we still see a favorable environment for equities. Further, fairer Indian valuations to peer amid Indian equities underperformance, YTD, and stable earnings delivery is also a positive. Lastly, weaker USD performance supports equity performance. History shows that periods of USD weakness are 1. Positive for overall global equity market returns, and 2. Result in outperformance of emerging market equities, including India, over US and developed market equities. So, in short, we still prefer equities, but a more balanced outlook, so a diversified equity allocation and selective opportunities through an overweight on mid-cap equities and a barbell strategy, sector strategy, which involves overweight on domestic cyclicals like consumer discretionary and financials, but with a defensive overlay through an overweight on healthcare. That's all for today's podcast. If you liked it, please like and subscribe. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.